Right away, though, we have to make a stop at CNBC, and we're going to talk about the refinance demand.
Yep.
So weekly mortgage refinance demand soars 16% as rates sink to the lowest level in over a year. This is not just some fancy headline. I also want to make sure we're saying that no one is at the top of the mountain screaming, "Everybody come for a refinance!" Like, that's not possible for everybody.
No.
There are definitely some limitations. We'll get into some of that. But, I mean, look, this is one of the things that is the kind of outcome of the aftermath of the market sell-off, and I'll say a mini contagion, if you will, because it didn't really go full bore, but it is definitely a little glimpse as to more to come, probably, whether it's really rapid or slow. It is more of volatility to come. The average contract interest rate for 30-year mortgage went from 6.82 to 6.55 on average, and applications spiked for refinances. They went up 16% for the week, which made that week 59% higher than 1 year ago.
Oh,
So,
wow.
like, snapshot in time a year ago to today, 59% increase. And Brian, you have seen that firsthand.
Yeah, no, this last week we got a lot of influx of people that needed a refinance. And the reason being, I mean, I think it was a combination of a lot of different things going on. People finally say, hey, makes enough sense for me to be able to refinance. Two clients actually reached out and they're looking to wipe out all their debt completely. We're working on some cash out refinances. But one of the very particular cases I am starting to see is people that got buy downs maybe a year, 2 years ago, or inclusively even 3 years ago. That time is starting to come due, and those rates are going to start adjusting and going up to the what the actual locked rate should have been. And right now, I am getting a lot of people saying, "Hey, well, where are rates at?" I know when we last spoke, or when I last did my loan with the other person, they said in about 2 years things would start easing up, and that's what we're starting to see right now. So taking them out of the buy down and just solidify them into a fixed rate that's not going to move anymore. And the goal is to always keep them under the last year's rate, so they never touch that high rate that they were supposed to.
That's a great point. And I don't know if you were coming into this ready to talk about the buy down. I'm glad you brought it up, though, because the buy down is something that someone who maybe bought in 22 or 23 at an elevated interest rate, and at the time had it reduced temporarily because of the 2-1. Now that's coming due in 23 if you got it in 21, or if you got it in 22, it's going to be coming due. So that is a great example for where some of this refinancing might already be taking place because of that. I know there's other reasons, which we're going to get to later, but this is the kind of reaction you kind of expect from the market when you see such a heavy sell-off, massive selling, and you see the treasuries kind of follow suit, and I'll say weaken, but in mortgage terms, strengthen, meaning that mortgage rates go down. We saw a significant drop in mortgage rates, and even here, that brought people off the sidelines big time to save money. I mean, you go from having like 5-6 escrows to like 19 in a matter of 48 hours. That's a big deal.
No, it's starting to feel like, hey, we're actually working again now. Hey, we're busy. But in a sense, it's a lot different as far as, the solutions that are being brought forth nowadays compared to a few years ago. It's like now you really have to understand the file, really kind of provide a solution, because it's not just hey, let me just make this transaction happen. It's okay, the money's cheap.
Well, I mean, to really quickly make the point there, I mean, you're talking about like back in 2020 and 2021. Hey, your refinance is going to be 2.5. Duh, do it. Like just do it.
Anything under like 2-3% was like, okay.
I need to purchase a home. Oh, my rate's gonna be 3. Okay, fine, do it. Like, but this is way more. What's the word? I don't want to say like structural, but strategic, I guess. Maybe it's strategic is the way.
So a lot of the approaches that I'm taking is, really breaking down, the client's debt, how much they're paying over here in monthly recurring debt for the credit cards, their, monthly car expenses, loans, or whatever it might be. And then giving them the clear path of saying, hey, well, if you clear up this much over here, we're able to then, consolidate over here and still give you a positive cash flow of X amount, depending on, what it is. And that's been, a lot of what the cases have been, where it's like, I have like $1,200 in a consumer debt that I pay monthly, or close to $2,000, and I need to get rid of all those payments. So it has helped a lot that they do have that option of doing it. But the biggest thing for me, and something that I wanted to bring clarity to, is that whenever you see the average rates on wherever you look at a Mortgage News Daily or NBC, they're going based off of every mortgage that's being written across the United States. Now, one thing about mortgage rates is that it's driven by your credit score, your personal debt to income ratio, and the debts that you hold. So when you're looking at that national average, it really doesn't tell you exactly what your rate could be. Because I will tell you from, insider knowledge is that I've clocked some clients in under what the average is right now. And that's because their credit tiers are a lot different. My advice is that if you are on the fence or you're not sure because you don't know what rates are at, or, you still think rates are a little bit higher than what you would like them to be, talk to a mortgage professional and really just give them your situation and let them really guide you through that, because you're going to find a lot of clarity and you'll understand how things really work, and you might be in a better position to be able to, do something with that.
Great point. And also to keep in mind too that, they're talking about the conforming average, but conforming there's still difference between conventional conforming loan limits, and then you have VA and FHA. They have different pricing in addition to the credit, the credit strength of the borrower. So keep that in mind as well. Interesting about this though, despite the refinance activity broadly picking up, the purchasability was kind of like meh. It was like not as much of a reaction, and I think maybe that could be because of the perception that it might be temporary, or maybe it's just still not enough. I think it's maybe a little bit of both. From kind of some things I've been looking at myself as in news space, but also talking to people. Like it's kind of like okay, that's a good shot in the right direction, but there still needs more to increase that affordability to get people off the sidelines.
Yeah, and another one that I've really been seeing a lot lately, and it's unfortunate, is a lot of divorce cases, and a lot of people finding now the opportunity to say, hey, now it makes sense for us to either sell the house or refinance, cash out, and split the equity. You stay with the house. I've been noticing that a lot, and I've started. There's a few realtors that I work with that have mentioned that, hey, I am starting to notice that, and people are starting to either make that decision of, hey, I'm keeping the house, you're getting the equity, I'm getting the equity, you're keeping the house. So that's also something that I have been seeing. And with the rates coming down, it pushes, a little bit more for that to be able to be done.
Well, I think that, for us specifically in the mortgage space, it's kind of like layer one. Oh, yeah, that sounds great for business. But layer two, you have to look at what's behind that. Like this is real material impact in the lives of people who are homeowners, who are refinancing for a variety of reasons. And so our little our little experience here over that week is a microcosm of the broader trend where I'd say tens of thousands of people across the country are experiencing some sort of financial relief or gain by moving themselves into a lower rate lock than what they had in 22 or in 2023. So this is encouraging news to me.
Yeah, and look at it like, taking the elevator or the escalator. Right now you're just coming down. There's going to be another level to come down. So I think you should just look at, what it is you're looking to do in the long term. And I always speak about that because you can't really foretell what's going to happen in the now. But if you have an idea and a sense of direction, it's going to be easier to make a decision right now. And I think that's one of the toughest things for, a lot of consumers and a lot of clients is that I don't know what's going to happen. Well, we don't either, but you can only account for what you can right now. And I tell my clients, if this is a solution that solves your problems right now, take it, because you don't know what's going to happen later on down the line.
Yeah, no, it's a good point. I think that advice is probably being given broad and wide and largely by the mortgage industry, of course, but I think it's being well received by homeowners who maybe have been silently looking for some sign of relief on the horizon, and now they're getting it.
And also on the flip side, not everybody is, right now at the right time to refinance. So
Correct.
Also make sure that when you're speaking to your lenders or you're getting quoted, you look at the paperwork, you look how much they're charging you, look how much, in origination and discounts, because some things I have been seeing from other industry members is that, the calculations on, you're going to get a lower rate, but it's also going to cost you this much, making the savings, not as favorable as they should be. So that's also something to be worried about. And if you don't know what that means, please reach out to us. That's what we're here for.
Yeah, and this might be a good a test run for you. If you're like, oh, hey, I missed this window, or maybe this is not the right window for me. Don't let the time pass and still be unprepared later. This would be a good time to then coordinate all your paperwork and make sure you got all your pay stubs in line, you got your bank statements all cleaned up, and they're all in order. You have good I guess organization is the best way to summarize my whole point here. Is like get all your financial house in order so that when the time comes up, you are ready to strike when the market is in your favor.
Yeah, 100%.